In the world of investing, understanding a company's worth is essential. That's where the price-to-earnings (PE) ratio comes in. Think of it as a quick snapshot of a company's stock price relative to its earnings. It's a simple tool that can tell you a lot about whether a stock is overvalued or undervalued. Investors use the PE ratio to assess if a company's stock price is justified based on its earnings. It's like checking if you're getting a good deal on a car. You wouldn't want to pay a high price for a car with a sputtering engine, right? Similarly, a high PE ratio might indicate that investors are overly optimistic about a company's future, even if its current earnings are low. Conversely, a low PE ratio could suggest that a company is undervalued even if it's performing well. The PE ratio is a fundamental piece of the investment puzzle. It helps you make informed decisions about where to put your money. Calculating the PE ratio is easier than you might think. It's simple division. You take the current market price per share of a company's stock and divide it by its earnings per share, EPS. Here's the formula. Let's break it down with an example. Imagine company XYZ is trading at $50 per share and its earnings per share over the past year were $5. To get the PE ratio, you'd divide $50 market price by $5 earnings per share. This means investors are willing to pay $10 for every $1 of earnings that company XYZ generates. Easy, right? Remember, the PE ratio is just one piece of the investment puzzle, but it's a crucial one to understand. When talking about PE ratios, you'll often hear the terms trailing and forward. Don't let these terms intimidate you. They simply refer to the time period the earnings per share are taken from. This is the most common type of PE ratio. It uses the company's earnings per share over the past 12 months. It's a look back at the company's recent performance. This type of PE ratio is a bit more forward-looking. It uses the company's projected earnings per share for the next 12 months. It's based on analysts' estimates of the company's future performance. Which one is better? Well, it depends. The trailing PE ratio gives you concrete historical data, while the forward PE ratio relies on predictions. Investors often consider both to get a well-rounded view of a company's valuation. Now let's talk about what those PE numbers actually mean. A high PE ratio generally indicates that investors are optimistic about a company's growth prospects. They're willing to pay a premium for its earnings. Think of it like a hot new tech startup. It might have a high PE ratio because investors believe in its future potential, even if its current earnings are modest. On the flip side, a low PE ratio could suggest that a company is undervalued or that investors are not as confident in its future growth. This doesn't necessarily mean it's a bad investment. Take a well-established utility company, for example. It might have a low PE ratio because its earnings are stable but not expected to skyrocket. The key takeaway here is that there's no magic number when it comes to PE ratios. A high PE ratio isn't always good, and a low PE ratio isn't always bad. It's all about understanding the context. Section 5. Putting PE ratios into context. Comparing apples to apples. When using the PE ratio, it's crucial to compare apples to apples. Don't go comparing the PE ratio of a tech giant to that of a traditional manufacturing company. They operate in different industries with different growth trajectories. Here are 3 key comparisons to keep in mind. Industry comparison. Compare a company's PE ratio to the average PE ratio of its industry peers. This helps you gauge if it's relatively overvalued or undervalued within its sector. Market average comparison. Compare a company's PE ratio to broader market averages like the S&P 500. This gives you a sense of how its valuation stacks up against the overall market. Historical comparison. Look at a company's historical PE ratio over time. This can reveal trends and potential anomalies in its valuation. By making these comparisons, you gain valuable insights into a company's relative attractiveness as an investment. Remember, context is key when interpreting PE ratios. Section 6. The power of the PE ratio. Investor advantages. The PE ratio is a powerful tool for investors for several reasons. Simplicity. It's easy to understand and calculate, even for beginners. You don't need a finance degree to grasp the basics. Accessibility. PE ratios are readily available on most financial websites and trading platforms. You can find them with a few clicks. Comparative analysis. As we discussed, PE ratios allow you to compare different companies within industries against market averages and over time. Valuation insights. While not a perfect measure, the PE ratio provides valuable insights into whether a stock is potentially overvalued or undervalued. In essence, the PE ratio empowers investors to make more informed decisions. It's a tool that can help you separate potential winners from potential losers in the stock market. Section 7, the PE ratio in action real-world investment scenarios. Let's bring the PE ratio to life with a couple of real-world scenarios. Scenario 1, you're considering investing in two companies in the same industry. Company A has a PE ratio of 15, while Company B has a PE ratio of 25. This suggests that investors are willing to pay a higher premium for Company B's earnings, indicating higher growth expectations. Scenario 2, you're tracking a company's PE ratio over time. You notice that its PE ratio has been steadily increasing, even though its earnings haven't grown significantly. This could be a red flag suggesting that the stock might be becoming overvalued. These are just two simple examples of how the PE ratio can be used in practice. By incorporating it into your investment analysis, you can make more informed decisions about when to buy, hold, or sell stocks. Section 8, Beyond the PE ratio, a holistic approach to stock analysis. While the PE ratio is a valuable tool, it's essential to remember that it's just one piece of the puzzle. Never rely solely on the PE ratio to make investment decisions. Here are some other factors to consider. Company fundamentals. Analyze the company's financial statements, management team, competitive landscape, and industry trends. Growth potential. Assess the company's future growth prospects, taking into account factors like market size, innovation, and competitive advantages. Debt levels. Examine the company's debt levels and its ability to manage its debt load effectively. Dividends. Consider if the company pays dividends and its history of dividend payments. By taking a holistic approach to stock analysis, you can make more informed and well-rounded investment decisions. Section 9, Common pitfalls with PE ratios, what to watch out for. Like any financial metric, the PE ratio has its limitations. Here are some common pitfalls to watch out for. Earnings manipulation. Companies can sometimes manipulate their earnings to make their PE ratios look more favorable. Be wary of companies with inconsistent earnings histories. Cyclical industries. PE ratios can be misleading for companies in cyclical industries like airlines and automobiles, as their earnings fluctuate with economic cycles. One-time events. Extraordinary events such as asset sales or lawsuits can distort earnings and PE ratios. Look for adjusted earnings figures that exclude these one-time items. Growth versus value traps. High PE ratios don't always equate to growth stocks, and low PE ratios don't always mean value stocks. Conduct thorough due diligence. By being aware of these pitfalls, you can avoid making hasty investment decisions based solely on the PE ratio. Section 10. Alternative valuation metrics, broadening your toolkit. The PE ratio is just one of many valuation metrics available to investors. Here are some other metrics to consider. Price to book, PB ratio, compares a company's market value to its book value, which is assets minus liabilities. Price to sales, PS ratio, compares a company's market value to its revenue. Dividend yield, measures the annual dividend payment as a percentage of the stock price. Free cash flow, FCF. Cash flow from operations minus capital expenditures, representing the cash available to the company. By expanding your valuation toolkit, you can gain a more comprehensive understanding of a company's worth and make better informed investment decisions. Section 11. The PE ratio, a valuable tool in your investment arsenal. The PE ratio is a simple yet powerful tool that can help investors navigate the complexities of the stock market. By understanding how to calculate it, interpret it, and use it in context, you can gain valuable insights into a company's valuation and make more informed investment decisions. Remember, the PE ratio is just one piece of the puzzle. Combine it with other fundamental analysis, industry research, and a healthy dose of common sense to build a successful investment strategy. Happy investing!